Self-storage occupancies and rates have been falling faster than we've seen in over a decade. Now, at the same time, we still have markets and we have assets that occupancy is not only high, but our rates are going up. Our overall revenue is up 40% higher than it was year over year, but some of our assets, occupancies are dropping, and some people are in trouble. It is not the same market in self-storage that it has been for the last 15 years. And 2023 is going to lead us to some big surprises, but it won't be all even. So here are the things that you need to know going into 2023 that are the dangers and the pitfalls that you have to avoid, but also where are the upside and where can you find the opportunity. Now, it is true going into 2023 that we are in the slow season. And some people have wondered, are we seeing low occupancies and rates dropping because we are moving into a slow season, which is traditionally the winter? Which is a great question. But when you look at it from a historical perspective, the occupancies that we're seeing and the rate drops that we're seeing are unlike any other slow season that we've seen before, especially not in the last few years. And this is the change that we want to see. It's accelerating faster. We are having way more move-outs and less move-in. And this is general across the United States. But looking at the individual markets, some markets are pretty much not affected right now, and other markets are even remaining strong. So how do we identify that? So what rents a unit? Why do some people rent units and why do other units remain vacant? And why has it changed? This is actually a really simple answer to me. It is housing. As interest rates have risen, the housing market has stalled out. And I'm not talking about people losing their homes. I'm talking about people stop moving. They're not buying homes, they're not moving. And that is bad for self-storage because 45% of all our customers come from the housing market. This happened right as we were entering into our slow season. So this was a big swing for self-storage. This all sounds scary, gloom and doom. Is that the reality of the situation? Honestly, it really depends on how you look at it. No is the obvious answer. As you can see from this chart right here, where we were previously at, especially in occupancy, was unsustainable. It was a bubble and we had never seen anything like it. Prior to just the last 5 years, the national average high was 86% occupancy. We believe right now storage is returning to a normal. Now, this means opportunity. Why? There's always opportunity when markets transit from a bubble or a bull market to a bear market, and you have buyers and sellers that don't understand where value's at. A lot of people have retreated, they're taking the money off the table because they don't know, and they're struggling with valuations. That means sellers are struggling to find buyers. If you're trying to get into the market, and if you're a buyer, this is really good. Why? Because this is an extrinsic value problem. I talk about this a lot. Extrinsic value is the market that is the buying and the selling of assets, right? So like the housing market or the self-storage market. The intrinsic value is what the asset makes. It's how much revenue is coming, what net profit are we getting. Interest rates and people being scared have really affected this extrinsic market. They can't afford to buy things what they used to buy for the assets. Now, while many markets, the intrinsic value has changed very little. Across our portfolio, all our assets are up on revenue year over year. Right now, we're negotiating with sellers who 4 or 5 months ago wanted $8 million for a price tag, and we're under contract at $6 million. The asset didn't change at all. That is opportunity for you in 2023. The market hasn't figured out the valuation with new higher interest rates combined with a returning to normal of fundamentals like occupancy, rental rates not going up at 10% plus every single year. As a buyer, this is a perfect storm for you to get into self-storage and find value that you haven't been able to get for years. With that said now, what does that mean for you? and the questions that you have moving into next year, understanding that the market isn't going to be like it was, but there are still lots of opportunities. Well, the best way to address this is to answer directly your questions. Let's start with the first question. If rates rise more, meaning interest rates, and the housing market slows down, people are being forced to leave their houses, wouldn't that be positive for storage because people are downsizing? Yes, it would. But what we're seeing is not that. Over 93% of all mortgage holders have an interest rate that is below 4.5%. The people that actually own mortgages today, it's very, very cheap relative to the market. So affordability for those that already own a home is really good. So we actually don't see them downsizing. Why? Because their income hasn't changed, their payments hasn't changed. In fact, it's the opposite. Even downsizing today, they may have to pay more. So they're not moving. And that is bad for storage. Where is the secret sauce or the secret formula to being successful? Is it the startup cost? Is it the business plan? Now, this is a great question, and really it's a two-part question. The first is, you've probably heard, you make your money when you buy, and that is universally true. Now, storage, what makes it successful is cash flow. This is a cash flow business. We have short-term rentals, and you need to buy it right because we do have fluctuation in occupancy. So when you're purchasing the asset, the price of the asset means very little to me as it is relative to the revenue being produced. Right now, when you're getting into it, our cash flow on our acquisitions is rising. Why? Because acquisition prices have been coming down. That's a really good spot to be in. So if you have an asset that you're looking at that has good margin, meaning you're going to be able to be okay if you have changes in occupancy, and then you structure that deal right when you buy it, meaning you're locked in on your debt, you're locked in on that acquisition price, and you know your major expenses and liabilities are fixed for a long period of time. Too many people do floating rates, or they need to refi in a short period of time, and then external changes sink what was a good deal. There was nothing wrong with that deal. So that acquisition price and structure is very, very important to maintain cash flow. Now, second is acquisition operations. Operations is everything. So the business plan, meaning, are you marketing, bringing new people in, and are you doing revenue management on the tenants? Are you keeping long-term quality tenants, and are you taking care of the asset? Now, price is very important to make sure it's successful, but if your operations fail, the price won't matter. Now, I've seen a lot of people that buy poor deals, but they're so good at operations, they make it work. But I don't see anybody that buys a deal and has poor operations and is successful. So the secret formula is acquisition, price, plus structure, operations, bringing people in, keeping them there, and quality of the asset and the tenant. All right, so what determines a market when we're talking about demographics, things like that? Now, it's important to know that I view the market in two different segments. So first, let's hit on the market itself. We're talking demographics, right? We're talking about employers, population growth, we're talking about income growth, all that thing. When I'm looking at that, the size of the market or the area of impact that I'm looking at that facility is determined by drive time. Not a 3-mile radius, not anything else like that. It's drive time to the facility. And I'm looking at the economic impact, right? Where people are driving to, what people are doing, housing that's starting up, what people are employed by, growth, all of that within that area of impact in the drive time. Now, the second part of a market that I'm looking at is the actual product market, meaning self-storage. So how many individual units are out on the market? How many storage facilities, how many individual units and individual sizes are out there? And what is the occupancy of them? And what does the rate history look like? I'm also looking for the future market of self-storage. What assets are coming on board? So a storage facility is going to be built. Are they not? Remember that the market demographic or the direct area I define from drive time, but that's customer. If I'm looking at the area of impact on other storage facilities, it's much farther. Why? Because their area of impact and my area of impact will intersect. So even though they may be 20 minutes away, their area of impact and mine will overlap. So it's really important to understand that the impact of the self-storage market is much larger than the demographic part of the market. All right, what is your strategy for storage next year? Well, our strategy is twofold. First of all, we're going after value add and opportunistic. We just opened our latest fund, which is an opportunistic play. Now, when we look at an opportunistic play, we're looking at two things. Underperforming assets, primarily due to operations, but also the physical nature of it, expansions, things like that. I want upside that people generally aren't trying to buy right now because they're worried and they're scared or they're nervous. Well, I can take time to get that upside. And so we're trying to find sellers that have little options, but good upside. Now, the next thing is structural. We're really looking at assets that are needing to sell, but because they have little options, will give us more ability to be creative on things like financing. Therefore, in 2023, one of our biggest strategies is seller financing. And we're looking at very creative ways to get deals done for sellers that have no options. This gives us a huge competitive advantage in the marketplace and allow deals that may seem dead to other buyers alive for us because we can structure it differently and get it done when others couldn't. That also means we can dictate a lot more of the pricing and terms on that asset. Those are our two main strategies that we've gone very hard into and will allocate tens of millions of dollars towards in 2023 that you can do the exact same thing. All right, moving into 2023, it's really important that you are not scared by what you're hearing and you focus on the intrinsic value, not the extrinsic value. That you're finding the opportunities that exist in the marketplace and you're being creative with how you get them done. Don't forget, leave your questions down below in the comments because we will be answering them. In fact, we'll be answering them on our podcast, which we update weekly with all the changes and what we're doing in the marketplace, what's working and what's not. Now, if you want to understand more about occupancy rates and why occupancy may be dropping but still good, check this video out here. It will explain a lot.